Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. Markets have continued their slow but steady march upwards since we met 2 weeks ago. New York's hit again new highs, interestingly with volatility falling both in bond and equity markets. Two events, though, particularly stood out. The first was Chairman Powell's landmark speech to the Jackson Hole Symposium of Central Bankers. In that, he raised two interesting points. Firstly, he reinforced his conviction that the current high inflation rates we're seeing in the US and around the world are transitory. And second, he drew some clear blue water between when he would start to taper bond purchases by the Federal Reserve, which is relatively soon, and when he would start to raise interest rates, which is probably out to 2023. The second event across the world in Beijing was more clarity and more understanding of what Chairman Xi means with his new common prosperity agenda. His regulatory onslaught on technology, on education, on property and many other sectors of the Chinese economy reverberated through the stock market and has caused substantial falls in many of the technology names. We'll try and assess both these points, see what they mean for world markets, see what they mean for asset allocation, and see what they mean for your portfolio. Let's begin with a brief snapshot of the world economy usefully prepared by the Bank of England. They've indexed GDP at 100 on the eve of the COVID crisis and looked at the progression from there. You can see that red line, China, extraordinarily up almost 10% from its pre-COVID level. US just going through that 100 number. Europe looks as though its economy will have recovered all the pre-COVID losses by somewhere in Q1 2022. They've done the same for the UK in a bit more detail, projecting out to the end of the year. There they're showing the UK economy recovering all of those extraordinary losses by December of this year. A radically improved picture than anything we could have dreamt of 6 months ago. The unemployment rate falling down to 4.5%, very encouraging, and inflation after a slightly weaker number last month continuing its upward ascent to around about 3% by year end. So let's tie these figures into the two big events of the last 2 weeks. First of all, Chairman Powell's speech to the Jackson Hole Symposium of Central Bankers. For the first part of his speech, he talked about why he genuinely believes this inflation phase will be transitory. That chart on the left there is drawn from his speech and shows the sharp surge in durable goods orders in blue, durable goods inflation, that has put so much upward pressure on prices. This is autos, semiconductors, industrial goods, which have been so affected by the squeezed supply chains. He draws the conclusion that if you look at history, durable goods inflation tends to be negative because of the downward pressure exerted by improving technology and production techniques. So he thinks it'll broadly be temporary. On the right-hand side, I've taken his two extracts from the speech on his comments on taper and interest rates. In terms of taper reducing QE, he broadly indicates that substantial further progress tests, particularly on inflation and unemployment, has broadly been met. So I think we can expect an announcement on taper in September and probably the programme beginning in December. Importantly, though, for markets in the second paragraph, he said these are not the same indicators I'm going to use for interest rates. I want to see much more progress on maximum employment goals. So I think we can safely say that interest rate rises will not come until 2023. A very robust support for markets, I think, in that statement. And of course, you could say, if he were slightly cynical, for his own reappointment, which he needs to get from Biden by February of next year. The second bigger event of the week was we got a little more clarity on Chairman Xi's common prosperity goals in China that have hit the technology industry, the property sector and the education sector so hard. They're certainly hurting the economy. Industrial production's fading, retail sales are weaker, Chinese manufacturing surveys and service sector surveys in the composite PMI are a lot weaker than expected. At 48.9, that's a contraction. Remember that 50 is neutral. Are we worried long term? Perhaps a little less so, because I think part of the statements, particularly as they affect technology companies, are broadly the setting of a regulatory framework which in fact we in the West would broadly recognise. He's looking to regulate the raising of money and capital, he's looking at regulating user data, and he's looking at regulating the algorithms that drive the time spent, mind share, and of course the dollars that flow into companies from there. And he's certainly looking to regulate to some extent profitability. I think this gives an opportunity potentially. We have a very small Chinese weighting at the moment, about 2% of our equity portfolios. Perhaps if this framework does become clearer over the coming weeks and months, it's an opportunity potentially to buy. So what does this mean for world markets? Well, the World Equity Index, as I indicated earlier, continues to climb. The MSCI China Index has fallen sharply, and this is one of the biggest differentials between the two since the crisis began. We see some opportunity, as I indicated again, with Chinese equities at these levels. On the right-hand side, I've shown the progression of world value and growth stocks. Look at that catch-up in growth. And on the bottom panel, the fall again in volatility, which I indicated earlier. So let's wrap up. We continue to be overweight risk assets for our composite accounts, funding that with a sharp underweight in bonds. We've got some precautionary positions in cash, and we continue to hold our alternatives, gold, renewables and infrastructure. We're a little bit more cautious though for our target return accounts, and there we're running a higher cash balance just until we have some more clarity on economic progression. Well, I hope that's useful. Thank you.